Joining me now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, great to see you. Happy Friday. What's your take on what's driving markets this morning? I want to get your take on Apple as well.
You know, it's interesting that Apple is not down 8, 9, 10%. It's holding its through. I think that when you hear analysts talk about iPhone sales and you start having them talk about, well, when are they going to make this push into India? When are they going to get more international? I don't think that's a story. I think the story here is services. Now, I remember about 4 or 5 years ago, we talked about services, and it was such a small little part. I said, it's nothing to get excited about. It's a quarter of all their revenue now, and the margins aren't 25, 30% like on the actual hardware. They're 70%. I mean, that's like Microsoft cloud service margins. So I think what we really want to look forward with Apple is the growth of services, because I think if this company is really going to continue to keep moving up, and why do we care? Because it keeps the S&P and the NASDAQ moving up. We really want to focus more on services and watch that margin. I think that's the story. It's not about iPhone sales being a little soft. But hey, if we get into next year and we get an actual bona fide recession because the Fed wants to keep rates higher, I think we might have a golden opportunity to buy Apple at a real discount. Just think about Apple back in 2013. It was a value investor's dream if you just had the courage to buy it.
Well, it's funny because even when it was a $3 trillion company, it's down from that right now. But even then, it was only trading at like, what, 19, 20 times earnings. Compare that to some other tech names. But, you know, Ryan Payne, jump in here, because yesterday when we were talking with Mark Tepper, Mark was pretty critical, and he said the problem with Apple is it's not innovating anymore. So here you have Lee Munson this morning talking about growth in services. We're not talking about growth in new products and creativity and innovation at Apple, are we?
No, we're not. And I think the bigger problem, as you just mentioned it, is kind of a value stock now, right? It's not really a growth stock like it used to be. And I think that's the bigger problem. It trades at 28 times forward earnings. And Lee, you just mentioned it, a couple years ago, that used to trade at like 15 times forward earnings. And I think that's your biggest problem with the mega cap stocks in general, is their valuations are just so high. And I mentioned this a lot, but if you take out that Magnificent Seven from the S&P 500, it trades really, really cheap right now. And I almost argue that you have a generational low in stocks outside of the Magnificent Seven. I'd argue the Magnificent Seven is not really that magnificent. When you start looking at valuation versus the rest of the market, you just have a lot of other places to put money right now that are good value.
What do you think, Lee?
Well, I totally agree with that. I mean, the places that I want to add money are, dumb places like large cap value and banks and tanks and cranks and shanks, is one of my buddies, Tony Dryer's always saying. You look at small cap value, be like, who cares? Well, they make a lot of stuff, right? And if we get a recession and then start coming out of it, you're going to see a reacceleration. But when you start looking at some of these smaller cap indices, I love the one over at Vanguard. They use the CRISP index versus the Russell. You're looking at still 8 to 10% growth going in forward blended 12-month earnings. And then you're looking at a PE of 10 or less. And you think to yourself, you look at the decline. I mean, you've got, 10, 15, almost 20% decline in a lot of names this year. I mean, you have your pick. I think the issue that we face right now is what is going to be the rate environment? Are we really going to be heading into soft landing? I think that's not the case. We have a soft landing price right now in everything but the Magnificent Seven. And granted, if the market wants to price in a hard landing, I'm cool with that too.
Yeah, well, look, part of that is going to depend on the Federal Reserve's next move, and that's going to depend on the economic data. So let's get into jobs right now, Lee. We're looking ahead to the October jobs reports coming out in 2 hours' time, 8:30 a.m. Eastern. The expectations, 180,000 non-farm payrolls added to the economy for the month of October. The unemployment rate expected to hold steady at 3.8%. How important is this report to you this morning, Lee? Is it going to be a market mover?
It's important. Well, I think it's going to move the market, but I'll tell you what in the report's going to move the market. I think it's less about how many jobs. I am a little bit more concerned about revisions from September because that was such an off outlier. What I'm really concerned about the jobs report is what wage growth is going to be, because it's not so much about the jobs, because those are good. Those get revised so much. I don't think a lot of viewers understand that we love the first number that come out because it gives traders a big market reaction, but we're always waiting around a couple weeks later to say, hey, what are the revised numbers? Because the revised number has been very, very volatile. But if we get wage growth not hot, then I think there's a lot of hope that the Fed will ease back and sort of temper their rhetoric. But if that wage growth disappoints, meaning it's too high, and we see the average hourly wages above what consensus expectation is, that will move markets. That's what the pros, that's what the traders are really focused in on. That's what I'm focused in on, because that's the only real problem that we have right now is the inflation in wage growth. I mean, we're hoping it's going to stay 4% or less.
This week, Jay Powell said wages are not a driver of inflation. He listed short-term factors. He basically came across as dovish this week. Lee, real quick before you go, you want to buy stocks going into year-end or not?
I do. I like the price we have last month. I think that if you see any type of softness coming in, if you can see anything back in when the S&P is like 42 something versus 43 something or 44 something, I want to be a buyer. But please, I don't want to be chasing the S&P at year end at 4,400. I think that there's more time that people have. Just be patient. My big focus, obviously, is I want to buy more 10-year treasuries at 5% if we see it. And we think that could never happen. Just hold your breath. It could.
Yeah, 5% is right there in reach. Lee, it's good to see you. Thanks so much.
Thank you.